Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
What a week. What an amazing 10-day run. What a 12 to 13-day run. The NASDAQ is partying like it's the 1990s when .com stocks came into the world and rocketed higher, only to hit a valuation wall in 2000. The Dow at one point today rallied 1,000 plus points, up 2.3%. The NASDAQ, if it closed higher, which I'm assuming it did, hit its 13th consecutive daily gain, which is the longest winning streak since it marked a similar streak that lasted until January 9th of 1992. The S&P 500 was on track for a fifth day in a row, but also 12 out of 13 days. Yesterday, both indices, the S&P 500 and the NASDAQ, hit fresh intraday and closing records. Today's action solidifies the recent surge in momentum that has the S&P 500 and the NASDAQ composite venturing further into record territory with relative ease. There was no economic data today of note. Crude oil prices remained deeply in the red throughout the trading session as both the U.S. and Iran declared that the Strait of Hormuz was open, though there was uncertainty about the extent of the reopening. A senior Iranian official told Reuters that while ships can now pass through the strait, transit needs to be coordinated with Iran's Islamic Revolutionary Guard. Separately, President Trump declared on social media that the U.S. blockade of Iran's ports would remain in full force until such a time as our transaction with Iran is 100% complete. At the same time, we learned late this morning that the White House is considering sending J.D. Vance back to Pakistan for another round of talks with Iran. As of midday, things were really solid. I had to record a little bit before the market closed. Bitcoin jumped to its highest level since February, boosted by optimism over reopening of the Strait of Hormuz. I've got a good strategy show for you today. I'm going to cover, believe it or not, a stock that may be acquired. I don't do that often, and it's a tech stock. I'm also going to hit Netflix's earnings. I'm going to tell you what I'm doing on the 10 years before I retire, of which I'm probably 3 or 4 years into that list. Bitcoin finally broke out of its tight range. It's been stuck in for weeks. It rose to just below 78,000, a level not reached since early February, as a risk-on sentiment floods back into the market. Because crude oil fell aggressively, 10%, fuel-sensitive sectors of the stock market like airlines and cruise companies got a big lift. United Airlines up 9.29%, Delta Airlines up 5%, Southwest up 8%. All jumped, as did cruise lines. Carnival up 9.2%, Norwegian up 7.9%, Royal Caribbean up 10%. Going the other way were the chemical and energy shares, which had soared along with food prices, along with prices of goods whose supply was constrained by the closure of the choke point to the Persian Gulf. Chemical stocks. Dow, ticker symbol DOW, down 11%. CF Industries down 9%. LyondellBasell down 11%. Those are tumbles. Those are big falls. Natural gas drillers like Apache down 9%, EOG Resources down 5.4%, Devon Energy down 6%, Coterra Energy down 5.9%. Remember how I talked about how the 1990s saw a rocket ship to the moon, if you will, of stock prices tied towards the internet? Intel, that's when they really started to put in PCs in everyone's home. With their recent surge, Intel shares just hit their highest level since the dot-com era. Intel surge of nearly 60% this month has the iconic American chipmaker stock price approaching levels last seen back in the 1990s, early 2000s. The share is up 90% this year. After soaring 84% in 2025, Intel is now roughly 8% from its all-time closing high of $75, established August 31, 2000. Oracle's having the best week it's had since late 1999. Some news out there today. Apple's China iPhone shipments surged 20% in the first quarter, even as overall smartphone shipments fell. That had that stock moving higher today. iPhone shipments in China jumped 20% last quarter. Rising memory costs have pushed prices higher across the industry, weighing on demand. Apple appears poised to ride out the broader smartphone slump, though. Its strength at the less price-sensitive high end of the market and its unusual leverage over suppliers helps keep its cost in check and give edges that rivals just can't compete with. Greater China remains a critical region for Apple, making up about 18% of its total revenue in the fourth quarter. The company accounted for 19% of China's smartphone market in the first quarter, up from 15% a year ago. Eli Lilly has a blockbuster on their hands. Their shares rose after preliminary numbers cited by Wall Street analysts showed strong uptake of its new weight loss pill. The FDA approved Foundayo on April 1st, and shipments began on April 9th. In its first week, roughly 1,400 prescriptions were written for the drug. Novo Nordisk, Lilly's rival in the GLP-1 market, released its GLP-1 pill earlier this year, and they found that it expanded the market. More patients started taking the drugs because some patients are afraid of weekly injections. So in its first week, Novo's pill had 3,071 prescriptions. Again, for a reminder, Lilly's at 1,400. So head-to-head, Novo wins, but Lilly's pill has an advantage over Novo Nordisk's pill. In large part, it can be taken any time of the day, with or without food. Lilly had $1.5 billion worth of pre-launch inventory ready ahead of the FDA approval. They should have a nice quarter. Wall Street likes that. With U.S. beef prices at record highs, America's protein craze is still driving consumption. One of the problems with the GLP-1s is we lose mass. And to get mass back, you need protein. From burgers to jerky, beef has long been ingrained in the American culture. In today's era of boy kibble, or protein maxing, comes at no exception. The cost of beef has never been higher than in recent months. The average price of all uncooked ground beef in the United States was $6.86 per pound in March, which is above by about 3 cents higher than the all-time high reported back in February. The cost of ground beef up 48% in the last 5 years. Cattle inventories currently hover around 75-year lows. We're seeing food inflation, and part of it is the cattle herd supply. The demand isn't really going away, especially with the United States having a desire to protein max right now. And with the FDA saying, eat more red meat. There's 86.2 million cattle and calves in the United States, relatively unchanged from 2025's figure. But it's about 7.4 million reduction in herd size since 2021. Despite U.S. beef prices sitting around record highs, demand for the red meat is soaring. Shoppers spent over $45 billion on ground beef, last year. One interesting comment came out on Live Nation this morning that I thought I'd share with you. It's Josh Brown. He says, a jury found Live Nation liable in an antitrust case tied towards Ticketmaster. The stock dropped on the news. Classic headline risk. His take, though, is this is exactly when you step in to buy. Markets often overreact to legal headlines. He pointed to past cases like Alphabet, where investors who sold on bad rulings missed huge upside. He thinks the core business live events demand remains strong. He sees this as a temporary legal overhang, not a broken business. So it's higher risk, higher narrative upside, in my opinion. You can always find me online at robblackshow.com. That's robblackshow.com. I do have an event coming up on Saturday. It's a Pints and Portfolio. Saturday, April 18th, 11:30 to 2 in Sunnyvale, California. It's a good opportunity for you to meet a financial planning expert. I'm bringing 2 CFPs with me, Ryan and Julie. Julie's going to be my CFP in probably about 2 or 3 years when my planner retires, if not sooner. So you can actually see who I work with, and potentially you can work with her. So if you're 50 plus heading towards retirement or in retirement, this is a great event. It's a good chance to meet me. I'll buy the beers. The idea is to get you a preliminary plan and do a Monte Carlo scenario for you to see what you're doing right, what you're doing wrong. Sign up at robblackshow.com. I've got a great show for you today. Coming up, I'm going to talk about Roku. After that, I'm going to tell you what I've been doing as I approach retirement and what you should be considering. And I finally wrap up with an analysis of Netflix's quarter. Is it a buy, sell, or hold? I'll let you know.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
I don't usually think about companies that can be acquired, but I saw a note this week that intrigued me. Roku announced it has surpassed 100 million streaming households worldwide. With over 100 million streaming households and growing, Roku is accelerating new platform capabilities, advanced personalization, and internal expansion designed to make TV even better for the entire streaming TV ecosystem. As the streaming landscape continues to evolve, Roku remains focused on being the TV platform audiences turn to. I looked up some of the analyst expectations. I do like that 100 million streaming households. There's a high estimate of about 168 on the stock. The average price target's 128. The current price is right around 111. The low estimate is about 100. Citizens is the one with a high price target of 160. Their thesis centers on Roku's presence in nearly 50% of U.S. broadband households. Currently labeling the stock as undervalued, noting that fair value calculations suggest there's still significant upside despite the recent 91% run-up in the stock. Roku recently posted $80 million in net income. Its latest report, double what it had originally guided. Now analysts expect net income to triple by the end of 2026. I'm liking some of these things. More streaming services are launching and consolidating, like Time Warner and Paramount. Roku ultimately wins because it acts as the neutral gateway, very similar to what Amazon has, where you can go to Amazon Prime and subscribe to any service you want, rent any movie you want, or you can use their services. That's what makes Roku fascinating to me. It's a ubiquitous free streaming service that comes pre-installed on a third of TVs. It could massively amplify distribution for a company like Comcast, Netflix, or Warner Mount. Roku is often forgotten stepchild of the streaming wars. It's undergone a radical glow-up since its 2008 launch. Founder and CEO Anthony Wood originally conceived the company as a low-margin hardware play, a cheap set-top box designed in partnership with Netflix to bridge the gap between the internet and the living room. 20 years later, Roku has evolved into a dominant meta platform, practically ubiquitous streaming operating system that operates in 100 million households. There is scale as a moat. The Roku channel, which utilizes a hybrid model of free ad-supported content, also known as FAST, free ad-supported content, and premium third-party subscriptions. It became the second fastest growing platform behind YouTube in 2025. It clocked a staggering 145.6 billion streaming hours. One analyst that I was reading this week, named Rich Greenfield, said, "Is anyone going to acquire it? Controlling Roku addresses a strategic deficit that content alone cannot. The power of the default." Greenfield argued there is a fundamental hierarchy in the living room. Owning the consumer's journey from the moment they power up their TV allows a company to dictate what is displayed and ultimately what is watched. He said, if I were David Ellison of Skydance Paramount, I would have bought Roku instead of Time Warner. It's sexy to buy content, but you get a lot more when you buy a TV operating system, which is how I want you to think about Roku. In an era where every major player is desperate for scale, Roku represents a turbocharger for whoever owns it. Now, their set-top box isn't as slick as Apple's. Apple doesn't really seem to be interested in going this direction. So they're out. But acquiring Roku, which generated $4.15 billion in platform revenue in 2025, it's no longer bottom fishing. Roku's market cap currently hovers around $16 billion. It would probably take a 25 to 30% premium to acquire them, pushing the number up to $21 billion. Who could do it? Comcast. CEO Brian Roberts collected the remaining proceeds from the Hulu sale to Disney. That was a multi-year saga that ultimately fortified Comcast's balance sheet. Then you get someone like a Netflix, but Greg Peters and Ted Sarandos, they're flush with almost $3 billion in the termination fee that they paid out in early 2026 after Warner Brothers Discovery scraped its Netflix merger in favor of Paramount Skydance. Amazon could do it. Andy Jassy, despite his commitment to the Fire operating system ecosystem, he might view a $20 billion check as a small price to pay for absolute dominance over the American living room. I don't think the Department of Justice would let that happen. The strategic logic is for an acquisition that extends far beyond simple hardware sales. Roku has successfully positioned itself as a discovery hub, the primary lens through which viewers can get into the streaming universe. Roku extracts a tax whenever a user signs up for a third-party streamer through its interface. They get a percentage of your subscription. They have the ad tech stack. By controlling the operating system, Roku captures first-party data that allows for significantly better ad targeting than the standard American linear TV app. And according to Antenna, over 33% of all new streaming subscriptions were funneled through aggregators like the Roku channel or Prime Video channels. So someone like a Comcast who's got Peacock or a Warner Mount that's got Paramount, you put this in front of the service and potentially get more business from even your competitors subscribing through that TV. Roku is the default software on 1 in every 3 TVs sold in America. Its customer acquisition funnel is perhaps the most powerful in the industry. For a legacy media company struggling with churn, buying Roku isn't just buying the app, it's buying the map to the consumer's wallet. If we take a look at the ad share, they more than double the competition. They're selling programmatic ads domestically in the fourth quarter. They had about 32% of the market share, where Amazon's Fire TV had about 15%, Apple TV about 14%, Samsung about 13%, LG about 10%, Vizio about 2%, Sony about 1%. Roku also faces stiff competition that threatens to erode its identity, though, as the neutral gatekeeper. Walmart's 2024 acquisition of TV maker Vizio was a structural shift, not just a retail one. By owning the OS, which is called SmartCast, Walmart can favor its own high-margin advertising and retail data over Roku's. That sent Roku's stock tumbling. Michael Nathanson noted that this essentially was a big move that weaponized the shelf space Roku once relied on. So I think a Comcast or a Warner Mount would make the most sense as an acquisition. In the end, they don't have to be acquired. Content companies run by executives. They view content as libraries, and that's the lens that they see their whole business through. Roku hasn't done terribly well in developing their own content, but they did partner with creators like Mr. Beast to bring native digital talent to the big screen. The ultimate roadblock to an acquisition might be the simplest one. Roku doesn't need to sell. With 15% year-over-year profit increases and a domestic lead that shows no signs of faltering, they're playing from a position of unprecedented strength. A decade ago, Roku was the box you bought to get Netflix. Today, Roku is the gatekeeper that determines whether Netflix gets seen. At this rate, the oft-forgotten stepchild may end up being the one who buys the house. I found that 100 million users, the total addressable market, very intriguing. And comparing their business model to Amazon's business model with Amazon Prime, I could see a strong case for Warner Mount or Comcast to acquire them so as to be the streamer, so to speak, that everyone wants to be. Multi-channel, multi-programs, subscription revenues from other companies. I have an event coming up at Pints and Portfolio. I'd love to see you at it. It's this weekend, Saturday, April 18th, 11:30 to 2 in Sunnyvale, California. It's about talking financial planning. Are you ready or not? What mistakes you're making or not? Sign up for the event. I'll buy the beers in Sunnyvale on Saturday. Sign up at robblackshow.com.
You are listening to the Rob Black Show podcast. For more information on EP Wealth, visit robblack.com. That's robblack.com.
I've been in financial planning and investment advisory, radio and television for 30 years. And one thing I've always done with media was be honest with you. Now I'm in the final 10-year countdown to retirement, and I want to share my life, my money, my family, what I'm doing. By 2030, 1 in 5 Americans will be retirement age. I'm in the final stretch of my rat race. I'm in my mid-50s. I've been working since I was 14, first jobs, early mornings, figuring things out as I went. The path turned into a 30-year career in radio, television, and financial planning. I've spent decades talking about markets, money, risk, and retirement, usually for other people. Now I want to talk about me. At home, it's me, my wife, my boys. They're going to be 16 and 18 years old this year. I got a dog named 0110101. We live in California, which has been both a blessing and a balancing act financially. Over time, we've built some meaningful wealth, tens of millions of dollars. On paper, that sounds like the finish line. I'm beginning a very different phase now, one that's less about accumulation and one that's more about intention. I'm probably about 5 years away from retirement, give or take. Close enough to see it clearly, far enough that I can still get it wrong if I'm not thoughtful. So this isn't a generic checklist. I'm going to go over what I'm doing, how I'm thinking about the final decade before stepping away. Some of these I've already done because, like I said, I'm maybe 5 years out. With 10 years left before you think you're going to retire, that's when you want to start to save as much as you can. Starting at age 50, you can contribute more per year to tax-advantaged retirement plans. These catch-up contributions for older workers can juice your savings. The IRA contribution limit for both traditional Roth and Roth IRAs combined rose to $7,500. If you're over 50, you can add an extra $1,100 catch-up contribution, pushing your max to $8,600. 401k contribution limits, similar to 403bs and 457s, you can now contribute $24,500 in 2026. But there's also a super catch-up rule. If you're 60 to 63, you can contribute an extra $11,250. For workers 50 to 59, you can contribute an extra $8,000. It's a good time to max out what you can. This stage for me is really mental. That 10 years out, because my number's already there. What does my life actually look like when work is optional is my big question. I've started having these conversations with my spouse. One of us leans towards retirement looking like travel and spontaneity and flexibility, whereas I value routine, community, staying grounded, and visiting my kids. Neither's wrong, but it takes effort to align. My boys are 16 and 18, right on the edge of adulthood. Their next steps will shape ours more than we probably realize. Where they go, what they need, how independent they become, all of it factors into what retirement looks like for us. So this phase is less about spreadsheets and more about imagination. It's about designing a life we both want to live. And honestly, at times I don't think we're going to want to be together because we have very different ideas. 9 years out, start to respect risk. Even if you've already won the game, start learning what allocation is. If there's one thing I know after 30 years in the market, it's that success can make you overconfident. With tens of millions of dollars in stocks, I don't need to take big risks anymore. The math works, the plan works. But the instinct to keep pushing, that doesn't just disappear. Always another opportunity for me to find out there. Another trend, another can't miss idea. And when you've been around markets long enough, you can make a convincing case for almost anything. That's where discipline has to come in. This isn't about abandoning stocks. I still love growth stocks. It's not about becoming ultra conservative overnight. I'm not going to all cash. I'm not going to all bonds. It's about recalibrating the purpose of my portfolio. Earlier in life, risk was a tool for growth. Now risk is something to be managed carefully because the stakes are different. A major drawdown at 40 is frustrating, but you have time, income, and energy to recover. A major drawdown at 60, that can change how you live. So I'm asking a simpler, more honest question to myself. What allocation lets me sleep at night, regardless of what the market does tomorrow? I stay away from high-risk investments and strategies such as crypto, options, or day trading. They're more likely to blow up in your face than to pay off. Watch out for unscrupulous companies that prey on fears about not having enough saved for retirement right around this age. With 8 years out, you need to clean up your financial junk drawer. Accounts from old jobs, investments that made sense at the time, positions that were once exciting, they now just sit there. I've seen people with portfolios literally on 100 stocks. And I'm like, you got to start trimming that. You don't have time. Get rid of the losers to get some tax losses going. I was able to find some old accounts that I forgot about. Even if they were small, like I was goofing off and putting $10,000 into Robinhood to see what the interface looked like. Roughly 31.9 million forgotten 401ks holding an average balance of $66,691 is out there for you to find. So with 8 years out, try to start simplifying. Not because you have to, but because clarity matters more as I get to retirement for me. I want everything organized. I want it intentional. I want it easy to understand, especially if I have a heart attack and die. This is my stage where I've already consolidated, I've cleaned up, and I've made every dollar have a purpose. There's nothing idle. 7 years out, I'm building the retirement budget. This is where you have to start replacing your income, thinking about it. It's easy to imagine retirement as a highlight reel, travels, hobbies, freedom. But the real version includes all the ordinary stuff as well. Healthcare, especially in California, it's a major line item. Factor in what you'll owe for Medicare Part B premiums, which cost $202 per month in 2026 and usually go up each year, matching rising healthcare costs. Taxes don't go away because the paycheck does. Lifestyle costs tend to creep higher than expected. Have you seen the cost of airfares recently and hotels? My boys are close to launching, but they're not fully there yet. And like most parents, will probably help more than we initially planned, whether that's education, housing, or just giving them a softer landing after college. I've seen this play out with clients. They underestimate this phase, not dramatically, but just enough to create stress later. With 6 years left, turn assets into income. $1 million should pay you roughly $40,000. My spending now is roughly $400,000+ with 2 kids in private school and college costs coming up. I want to replace that when I retire. So $10 million is my ballpark for equities to have dividends or maybe bonds to have yields. But right now my stocks all yield less than 1%. So I'm not there. But I have started buying dividend stocks like Caterpillar that I want to be able to give to my kids while the income supports me in my life. I get dividends from stocks. I get income from real estate. I get strategic withdrawals that could be sustainable. I use an option overlay strategy for my high concentrated positions in Apple, Microsoft, and NVIDIA. So it's not just about maximizing returns anymore. It's about creating consistency, a reliable income. Because in retirement, cash flow is confidence. With 5 years out, start making the big decisions. When do I actually think I'm going to retire? This is the stage I'm at right now. Do I fully retire or just evolve into something lighter? Do we stay in California? Do we travel the world? Will she travel with me or not? I don't know. There's a lot of questions. We've been so focused on our kids. So I'm starting to think about when I'm going to take Social Security. If I take it at 62, which is when I can, I'd receive roughly, as an example, $1,400 a month. But $2,000 a month if I take it at 67 and $2,400 a month if I take it at 70. I've gotten rid of all my high interest debt. Never really had it in the first place. I want to walk away completely knowing that my money's working efficiently. With 4 years out, the mindset shifts again from building to protecting. This includes reviewing insurance coverage. If you plan to retire before qualifying for Medicare at 65, how you can maintain your healthcare insurance. COBRA. Think about long-term care. Start structuring assets efficiently. Make sure legal documents are in place. With a family and significant assets, the goal is simple. Make sure nothing avoidable can go wrong. This is the years of insurance, the final 5, with 4 years left out. With 3 years, I think I'm going to start test driving retirement. But first, before I do that, I'm going to review my estate plan to make sure that my money passes efficiently to charitable causes and to my children. If you own a house in California, you should have a trust. You can save money on estate planning. These instructions override your will. If the wrong person, such as an ex-spouse, is listed, he or she will inherit the accounts when you pass away instead of your preferred heirs. I had to make sure that all the previous girlfriends were off all the documents. But I also have a trust, and my trust attorney works closely with my financial planner at EP Wealth. One of my wishes in retirement is I want to retire into a version of the life that I've never lived. I want to teach, and I want to travel, and I want to eat well in other countries. I'm a big fan of aglio e olio. So 3 years out, I can try to go to Italy and see if I really want to do that, because I know no Italian. I have to test it. I definitely know that I don't want mountain snow. Maybe mountain springs, but not mountain winters. With 2 years out, I'm doing my final stress test. What if the markets drop significantly? What if inflation sticks around longer than expected? What if health issues arise? After 30 years of building plans for others, I owe it to myself to be just as rigorous with my own. No assumptions go unchallenged at this part. I have to figure out Medicare Part B, Part D. I got to figure out with my income expectations on my tax returns. I'm probably going to get hit some IRMA charges. IRMA eligibility is determined by Social Security Administration. It's calculated on a sliding scale with 5 income brackets topping out at $500,000 to $750,000 for individual and joint filings. And in my final year, I want to land the plane. But honestly, I'm probably going to work a little bit till the day I die because I like it. Then again, a stroke or a heart attack can change everything for me. So that final year before you retire, it's all about transition. It's about setting expectations. My boy's stepping into adulthood. Fingers crossed, maybe I'll be a grandfather one day. That means shifting financial responsibility gradually, even if it's uncomfortable at times. I have a financial planner because when in my 70s, I don't expect to have as good of a mind as I do in my 50s. I want a sustainable life. Retirement isn't about becoming the safety net for everyone forever. The final thought here is it was never just about the money. After 30 years of talking about money, I can say with complete clarity, the financial part is only one piece of the puzzle. The real work is staying connected with my wife as life changes, letting my kids become independent, reducing my sense of purpose beyond work, and figuring out what a random Tuesday looks like when no one is expecting me to be anywhere. Because if I get that, if life works, then the money simply did its job. It got us here.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Let's talk about a widely held company that reported earnings last night, Netflix. The shares streamed lower despite a first quarter beat. It was second quarter weakness in guidance that stole the show. Netflix down roughly 10% following its first quarter report as a strong headline earnings per share beat was overshadowed by that disappointing guidance and question about the quality of the earnings upside. Revenue grew 16.2% year over year. Wow. To a record $12.25 billion. The company reaffirmed its 2026 revenue outlook of $50.7 billion to $51.7 billion, and operating margin guidance of 31.5%. The first quarter earnings beat was largely driven by the $2.8 billion termination fee tied toward Warner Brothers' deal, raising questions about the quality of the upside. Revenue of $12.25 billion plus 16.2% year over year came in ahead of expectations, as I mentioned. The second quarter earnings per share guidance disappointed despite the recent U.S. price increase, with operating margin expected to be 32.6% below the 34.1% in the year-ago period due to higher content amortization. Netflix expects second quarter to have the highest year-over-year content amortization growth rate in 2026, pressuring near-term margins. Management expects operating margin expansion to resume in the second half of 2026, with year-over-year growth in the third quarter and fourth quarter. They mentioned that engagement remains strong, with the company's internal quality metric hitting an all-time high in the first quarter. The advertising outlook remains intact, with Netflix reiterating its expectation for ad revenue to double to $3 billion by 2026. So far, they said early signals from the recent U.S. price increases are tracking in line with expectations. Of note, co-founder and chairman Reed Hastings is stepping down from the board, which may also be weighing on sentiment. He was there in the beginning. He's now 65 years old, and let's just say he probably deserves some retirement time. He mentioned on his way out, well, he's not completely on his way out, but he mentioned the company's in good shape. They don't need me anymore. So Netflix delivered a headline-grabbing earnings per share beat, but the market is looking through much of that upside, given it's primarily driven by a one-time $2.8 billion termination fee. The bigger issue is the softer-than-expected second quarter guidance, particularly the year-over-year decline in operating margin tied towards elevated content amortization. The stock had a strong run into the quarter, climbing from the mid-70s to around $108, leaving little room for disappointment. Analyst Laura Martin at Needham said Netflix reported first quarter revenues of $12.25 billion, up 16% year over year, 1% above her estimate. She said, "We are buyers of Netflix on weakness. Here's what we like the most about their first quarter 2026 numbers. New mobile engagement products such as vertical video podcast, and kids game will lower churn, add pricing power, and improve LTVs. They also like that managing fandoms is what YouTube influencers do best and is therefore every media company's job to be done. We believe in old media, Netflix does this best alongside Disney." Netflix history in the Silicon Valley makes it an early adopter of new technologies, including acquisitions with generative AI capabilities, better recommendations, and improved personalization. It's an interesting reason to like a company because they're located in Silicon Valley and they can adopt new technologies faster than others. So not only are you getting the generative AI capabilities, but better recommendations and improved personalization. Monetization follows time spent, she believes. Some analyst price targets. Canaccord Genuity, their new price target is 125. They have a buy rating. Guggenheim, they cut their target from 130 down to 120. Buy rating. Oppenheimer cut their price target from 135 down to 120. Outperform. Piper Sandler from 103 up to 115. Overweight. KeyBank went from 115. They stayed at 115. TD Cowen stayed at 112. And Rosenblatt has a neutral with a $95 price target. The dialogue amongst analysts today centers on quality versus quantity. Like we've mentioned, the Hulu Warner windfall. Almost every analyst noted that the $1.23 earnings per share was boosted by that $2.8 billion termination fee from the failed Warner Brothers deal. Piper Sandler's Thomas Champion noted that while the results weren't flashy, the underlying core business is stable. Another analyst thought was the advertising growth. One big intellectual win for the bulls. Netflix reiterated that its ad revenue is on track to double to $3 billion by the end of 2026. TD Cowen highlighted that while hardware-adjacent players are noisy, Netflix's move into video podcast and AI-driven content production is a real long-term margin play. And of course, analysts brought up the Reed Hastings factor. There's a minor emotional drag on the stock as co-founder Reed Hastings is officially stepping down from the board. Analysts are watching to see if the Peters Sarandos era will lean more towards aggressive capital returns like buybacks now that the pioneer is moving on. Wall Street likes the story. Most firms maintained a buy rating or overweight rating, but they've reset their expectations for the next 3 months to see a fair value closer to 115 to 120, suggesting that today's dip below $100 might be an attractive entry point for those who believe the ad tier growth story is sticky. It's interesting times to say the least. As far as Netflix, I do remember the day, back in 2000s, I had moved to California, and in the 1990s, I just worked my butt off after college, and I missed shows like Sopranos. So when I came to California as single, at a nice home, I would get the 3 DVDs for the weekend, and I would just go through a whole season, or almost a whole season of Sopranos, go back to work on Monday morning, drop those returns in the mail, and wait for another 3 DVDs to return. I think we all have some nice memories like that when we're thinking about Netflix. I think it's a long-term accumulate, and I think you can pick it up at these prices. Of course, you want to consult a broker advisor before taking any action on any stocks ever mentioned. But if you want to talk stocks, if you want to talk investing, come on out this weekend to a Pints and Portfolio Saturday in Sunnyvale, California, 11:30 to 2. It's a Pints and Portfolio. I bring 2 financial planners with me. One of them is Julie, one of them is Ryan. They both work with the EP Wealth. They'll answer your questions. They'll give you feedback on what you're doing right, what you're doing wrong. and they'll give you a free Monte Carlo scenario preliminary plan after the event. I don't know of any other firm that's willing to commit that time of money, that amount of time and money to giving you a freebie that's really useful. Sign up for the event tomorrow, Saturday, April 18th, 11:30 to 2 in Sunnyvale, robblackshow.com.
Visit The Rob Black Show online at robblackshow.com. Listen to archived podcasts, market updates, and information from EP Wealth's certified financial planners online at robblackshow.com.